why the instant asset write-off is a media hype and how it actually works. The instant asset write-off was initially announced by the government back in 2016. Each year, the government have revised it and put a shiny new little coat on it, which makes it look as though it's new. Here's a breakdown of the actual benefits and cons to the instant asset write-off. It's important to note there's different amount thresholds based on different income levels for your business, the time at which the asset was purchased, and the asset value. To keep this simple, we're going to use quite a general approach. If you want a more specific analysis, reach out to us. So let's wind this back and talk about depreciation to start with. Depreciation is claiming the cost of an asset over its effective, useful life. As an example, if you bought a bit of machinery that cost $100,000 and you deemed that it was useful to your business for 10 years, it has an effective life of 10 years. To keep things basic, if you claimed it on a straight line method, you'd be claiming $100,000 over 10 years, which is $10,000 a year. Now, a couple of things to consider is based on this approach, we're saying that this asset has zero value to your business after 10 years. So the way depreciation works is that we claim $10,000 of this asset as an expense towards your business per year. $10,000 in year 1, year 2, all the way through to year 10. And as we claim the depreciation, the value of the asset declines by $10,000 each year in your business. What this does is it reduces your taxable income in your business by $10,000 each year. So that's what we call simple depreciation. Now, the instant asset write-off brings that entire deduction of $100,000 into one financial year. So instead of claiming the depreciation of that machine over 10 years, you're claiming it in year 1. Why that is good and why the government sell that is because it's reducing your taxable income in the financial year by $100,000. What that results in is lower taxable income and lower tax payable by your business in that financial year. So that's a great cash flow boost for your business for that year. What the government failed to tell you and the media is that by doing this, you're missing out on deductions in year 2, 3, 4, all the way through to year 10 because you've claimed everything in year 1. So although this has given you the cash benefit in year 1, it's actually starving you of the deduction in the following years, which what that means is that then your effective taxable income is going to be higher in years 2 through to 10 because you don't have that deduction anymore that you ordinarily would have if you'd claimed using the simple depreciation method. The other issue this creates is if you were to sell that asset halfway through its effective life. So ordinarily, using the depreciation method, if after year 5, you were to sell your bit of machinery in this example for $50,000, the depreciated value of it, $10,000 a year, would bring it down to a value of $50,000 in the books. So if you were to sell it for $50,000, there would be no gain. There would be no taxable gain and no tax to be paid on that sale. Using the instant asset write-off, what you've done is you've created a zero value in your books by claiming the entire depreciation in year 1. So if in year 5, you sell that asset, this machinery, for $50,000, that's actually a $50,000 gain. So you have to pay tax on $50,000 income. So once again, we step back. Even though you've got a $100,000 deduction in year 1 and reduced your taxable income in year 1 and paid less tax, you've now created 2 tax negative effects. Year 2 to 10, you're missing out on the deduction of the depreciation. But also, if you were to sell that asset halfway through its effective life or any point in time, it's got a zero value in the books. So if you sell it for $1, you're paying tax on $1. These are critical things to analyze and understand when it comes to depreciation and instant asset write-off, because a lot of people and a lot of clients jump on the media hype and want to claim their asset straight up. Yes, there is times where it's suitable for your business, but you need to have a clear understanding of how it works and identify, is it an asset that you're going to definitely keep for the life of the asset and not sell? Because that's when instant asset write-off works for you. But if you're not sure that you're going to keep it until it's got zero value in your books, then perhaps instant asset write-off isn't the best thing for your business. Obviously, this needs a customized approach and customized analysis based on your business, the asset value, the effective life, your taxable income. But it's the conversations that you should be having with your accountant before you buy the asset or once you've bought the asset, so you can factor that into your tax planning and know whether you want the deduction straight up or whether you want to have an ordinary depreciation system in place. If you found this video insightful, be sure to check out our other videos.